Welcome. Thank you all so much for joining us. I'm Josh Schulz, publisher and CEO of the Los Angeles Business Journal, and it's a pleasure to be hosting our 26th annual Commercial Real Estate Awards and Forum. Today, our expert panelists will offer a look back at the unprecedented challenge that the commercial real estate industry has faced this past year, and they'll also be providing insights on how the greater Los Angeles market will be impacted this next coming year. We have three amazing panels lined up for you today. First, we're going to cover a brokerage update on office and industrial. Second, we'll discuss many of the changes that we've seen from a capital and a legal perspective. And then lastly, we'll talk about development, what it's looked like this past year and what the future holds. In just a moment, I'm going to be introducing our first panel and we'll get things started. I will note that many of you already submitted questions via the registration app, and we were able to incorporate several of them into today's Q&A. So thank you for participating in advance. If there's other questions that you'd like us to try to address, you can use the Q&A format here as well. One other housekeeping note, we're going to be conducting a live poll throughout each of the panels. So when you see a question pop up on your screen, we'd love for you to participate and share your opinions. We'll then be publishing these responses to all of the poll questions online and in next week's print edition of the Business Journal. So before we get started, I want to thank our sponsors for their investment of time, resources, and knowledge that all greatly contribute to today's discussion. I also want to thank them for their support of next week's awards program as well, which is part 2 of this series. So many thanks first to our diamond sponsor, AECOM Hunt, AECOM Tishman, to our 4 platinum sponsors, CBRE, Farmers and Merchants Bank, the Klabin Company, and Worth. And many thanks as well to all of our gold sponsors, AECOM Capital, the Albert Group, Clune Construction, Colliers, Hathaway Dinwiddie AECOM Hunt Joint Venture, Lendlease, Altman's Construction Company, Parker Brown, Prologis, Vineyards at Porter Ranch, and Westmac Commercial Brokerage Company. Thank you all so much. We greatly appreciate all of your participation in today's program and in next week's awards. All right, well, I'm excited to get things going, so we're going to jump right into things. It is now my pleasure to introduce our very first panel. It's the first of 3 rock star panels, as I think you're going to find out. Please welcome Darla Longo, Vice Chairman with CBRE, Lisa Reddy, Vice President, Prologis, Kevin Shannon, Co-Head of U.S. Capital Markets with Newmark, Jaclyn Ward, Managing Director, JLL, and many thanks to our moderator of this first panel, Jodie Poirier, Executive Managing Director, Greater Los Angeles with Colliers. Jodie, thank you so much for being here. It's a pleasure.
Thank you, Josh. Appreciate it. Well, I'm excited to jump into our all-star panel here that we have gathered. So let's jump in. The first question really is a general one and geared more towards the office sector, which really applies probably to the majority of us. So Jaclyn and Kevin, as we see people returning to the office, what does that look like and how is demand going to change?
Sure, Kevin, I'm happy to take this and thanks for having us. I'll kick us off with 2 key themes that support the crystal ball prediction that the office is not dead. One is that office space and commercial real estate, for that matter, will continue to serve as this vehicle to support business productivity, which is key. And then 2, despite the momentum that is starting to pick up around reentry, we are not going to see an automatic on switch that comes on related to, broad reentry into the workplace. If you are just reading the big headlines, you've seen a recurring narrative of work from home forever, and that story that continues. But many of these users, as you've seen, are in content creation and tech companies. But what I find most interesting is that when you pull back the curtain on those headlines, those exact same companies are the ones that have made sizable new lease commitments during COVID throughout major US cities. JLL conducted a survey last year in the Bay Area, major tech companies, and about 65% of them indicated they plan to return to the office by summer of 2021, which is now on the horizon. The summer, fall 21 reoccupancy plan, it's a timeline we continue to hear, but again, it's not going to be an automatic on switch. And timing aside, the way that office space is going to be utilized differently is something that companies have just started to scratch the surface and get their arms around. So the broader impact of mobility, work from home, flexible hours is yet to be truly realized as far as a direct impact on square footage and demand. But anecdotally, last 6 weeks across the LA basin, we've seen several companies re-engage the market looking for new office space, occupying some time in the next 4 to 12 months, which may suggest that we've got summer vaccinations on the horizon. There may be some pent up office demand for those tenants that have sat idly with their plans since March of 2020.
Thanks, Jaclyn. Kevin, piggyback onto what Jaclyn said there, and as well as would be interested to hear anecdotally what you're feeling. I concur with the anecdote that Jaclyn said in terms of the last 4 to 6 weeks seeming to be an uptick in activity. What are you seeing, Kevin? Maybe muted.
I'm unmuted. Okay, can you hear me now?
Yes, sir. Go for it.
I would like to say that I'm proud to be on this panel with 4 women. I think it's a terrific accomplishment. We need to do more of that. So thank you. Congratulations to the LABJ for putting that together. I had 3 sisters and my son has 3 daughters. I mean, 3 sisters as well. So I'm used to being surrounded by women, but it's a good thing. But I concur. Office is not dead. The honest answer to how we get back to work, though, is we really don't know. That's the honest answer. There's a lot of reports out there, and there's a lot of headline news about Salesforce is you can work from home forever. As Jaclyn said, the big tech companies have been taking space during the pandemics. Their headcounts have grown by about 10% since the pandemic started. And so, and the competition for talent with those types of companies is as fierce as it's ever been. And competitive advantage is going to get us back in the office. Right now, working remotely, you're not at a disadvantage because everyone else is working remotely. But once you get back in the office, relative to mentorship, building a culture, creating new relationships, you need to do that in person. If you're going to recruit, you want to do it in person. And so people are going to get back to the office the second half of the year. From a capital markets point of view, though, capital markets want to know what's the market like once people get back in the office, what's the velocity of the recovery, and what's going to be the utilization of space. And the answers to those questions we don't know. If you look at data points for industrial, they're clear. Data points for life science, they're clear. Data points for office are especially murky in markets, especially like San Francisco, right, where it's impossible to underwrite where rents are. And if you read, the research, Townsend Group came out last week and said, that work from home is going to decrease demand by 9 to 12% long term. Green Street's made the call that it's 10 to 15%. On the flip side, you've got Price Waterhouse that had a survey of prominent COOs, and 63% of them said they're going to need more space in 3 years. And so the answer is nobody knows. I would like to remind everybody after 9/11 that, the top floors of high rises were always, people were saying there's going to be a 25 permanent vacancy factor. That didn't happen after a couple of years. I think once the vaccine rolls out, I do think you're going to see more hybrid work models. But I still think, that senior people, especially in high paying markets like ours, are not going to want to share desks. Even if they come in 3 times a week, they're going to want to have their own desk. So I do think, office is going to come back, and it's competitive advantage. Once your comrades are in the office and you're working from home and you're not part of that group, part of the office politics, if you will, you're going to be worried about, am I missing out? Am I losing? And so it's the same as, trying to visit clients. Once your competitor starts flying to visit the client and they're not doing Zoom meetings, you're going to get in that client's office as well, because it's going to be competitive advantage that drives us getting back into the office.
Thanks, Kevin. And let's talk a little bit about landlords. What can they do? Both Jaclyn and Kevin, what can they do to attract tenants, during this time? Certainly activity has been muted over the last year. Now that it is picking back up a little bit, what should they be focused on in attracting tenants?
I think for me, Jodie, the two words that come to mind are flexibility and wellness, right? On the flexibility front, Kevin just talked about there's a lot of uncertainty, right? We don't exactly know how companies are going to be occupying office space on a go-forward basis. So if tenants are fluid in new ways that they might occupy space, they're going to be looking to landlords, right, to offer solutions that help fit that flexibility. So from expansion and contraction rights to shorter lease terms to additional capital if they have to reinvent or reconfigure their space. I think the landlords that are going to have an edge are those that are willing to think outside the box on flexibility and really partnering with tenants. And then on the wellness front, the buzzword right now, and certainly a very broad term, but if companies are going to have to make it compelling for their employees to come back to the office, Kevin mentioned recruiting and retaining talent is still top of mind. Wellness is a studied and proven factor to drive productivity, collaboration, and engagement, right? So that's everything from outdoor space to touchless experiences, street to seat, to great window line and natural light and ceiling heights, right? So those landlords that currently have those features in their buildings or campuses, or those that are investing in those type of features, are likely to have better traction with attracting tenants now and on a go-forward basis when we do come out of the pandemic.
Thanks, Jaclyn. Let's pivot to industrial for a bit. Darla, I'm going to kick it off over to you. The surge in e-commerce has certainly, among other factors, has been propelling demand in the industrial space. Do you feel that we're going to see that record demand continue?
Well, it's certainly been an amazing last year by far. We absorbed over 240 million square feet net, which was 11% higher than 2019. And there's really no projection that that's going to slow down. And for a couple factors, we have the reverse logistics. If you think about a third of the goods that are going, that people buy online, a third of those they return. So reverse logistics is just at its infant stages, and how that is going to occupy space and what's going to happen as well. And I think we also have to look at safety stock. We got Amazon, Walmart, every retailer got caught short with not having safety stock. So I think the market has absorbed a lot of that space already, but I do think that's going to continue to grow. We had a call with our leasing boots on the ground team just yesterday, and it was the most optimistic I have ever heard in my 43 years in the business. So it doesn't look like it's slowing down. So I think 2021 through 2022 is going to be continue to grow until things settle in and everybody finds what they need to do, what's the new normal, as soon as we get out of the pandemic.
I love to hear the optimism, and I'm sure Lisa does as well. So Lisa, with demand at record highs, particularly in warehouse and distribution centers, and that capacity remaining so tight into 2021, are you feeling across your portfolio a shortage of space, and how do you expect the situation to play out?
Yes, I do love the optimism, and definitely in many locations, we are already feeling competition for limited availability in logistics real estate. In fact, the national vacancy rate is about 4.8%, which is near its historic low. And as I'm sure many people on the call know, I mean, Greater LA is at 2% or just under. So vacancy rate actually held pretty stable during the pandemic, even as new supply came online. We saw a big surge in leasing activity in Q4. Throughout last year, we also saw strong pre-leasing in the construction pipeline and also an increase in build-to-suit activity throughout the entire year. So, as we all saw, there was definitely a construction pause in activity late last spring because of the start of the pandemic. And because of the construction gap, we do expect inventory shortage in a lot of the top logistics real estate markets in the first half of 2021. And in fact, I can even feel it in my own portfolio here in Southern California. I mean, the amount of calls I'm getting for available vacant space or space coming available, it's like numerous calls for the same space that we don't even have right now.
Darla, when talking with landlords, reflect a little bit on that. Are you hearing and feeling the same things among the various landlords you're speaking with on a daily basis?
Oh yeah, absolutely. There's no question that we clearly have a shortage of supply, and I think that's going to continue throughout the year. And that's driven a lot, if you think about California as a whole, just the challenges to get things entitled and up out of the ground and built. And in addition to that, we're experiencing a shortage of construction materials, and space overall has been rapidly absorbed. So, and we cannot produce enough to really meet the demand that's out there today. So yes, that's a common theme.
And in terms of tenants on the logistics side, what are they particularly looking for now when it comes to warehouse space? Is there more of a focus on automation and technology, for instance? What are you seeing there?
Well, I think for the first time ever, our asset class has rental appreciation, and that is for the sole purpose that it has been the lowest cost denominator to operate. And we're finding that companies like Amazon, Walmart, Target, logistically are looking for location. But in addition to the location, they're taking a hard look at what the availability of power is to serve the warehouse because of the automation. They're looking at how much labor, do they have abundant labor, and can they, are they stealing from other neighbors, or is there more neighbors, or is there labor in that general area that commute into the warehouse? So I would say today we have a structural shift in what our industry is, from classic warehouse to truly being logistic. And I would also just like to comment that rents are rising at an incredibly rapid rate, predominantly because we have the run room that we've never had in our business, but more importantly, it is all of these other factors that come into play in the client's decision-making. It's no longer, I've got to go to the outskirts and get the cheapest rent. And that's a big change that we've never seen.
Mm-hmm. And Lisa, from a investor, developer, landlord perspective, how are you all addressing the challenges of power, labor, in either retrofitting buildings that you have that are older in your portfolio, or in developing new sites? How are you all attacking that?
Yeah, I mean, Darla hit the nail on the head in terms of location and, the need for power. So we basically, with our existing portfolio, we look at, okay, where is this asset situated with respect to, the urban core? Do we think it's going to be a last mile facility? Can we go look at a power increase? But, the power increase won't come until we bring a user that demonstrates the need. So, we look at our infrastructure and the asset. Do we have, the capability, or will it cost a certain amount of capital to increase that power? So it's just proactive thinking for where we know the asset is, who we think the user is going to be, and can we get ahead of it? And, in addition to Darla's comments about the facilities, a lot of users we've been seeing lately have been wanting an increase of auto parking for their employees. So, in the past, it was an increase in trailer storage. Now it's both trailer storage and auto parking. And also the users who are not doing as much, automation in terms of, the movement of goods, they're doing more racking. They're really looking for the higher clear height. So they're really wanting to capitalize on cube capacity. So, when we're building a new facility, we take that all into account. How high can we go? Let's aim for the highest we can possibly and still be, within market. And if we get a user who needs to bring in automation, then, we've kind of killed two birds with one stone.
All right, let's switch over a little bit more into the investment side of the ledger. Kevin, you touched on it briefly earlier in your comments in terms of, where is underwriting on the office sector and how investors are approaching that. What is your overall outlook in the office sector from an investment standpoint? Maybe muted again.
It's a slow start to the year for office in LA. It's because of the lack of data points I talked about. We're telling most of our clients not to sell if you have vacancy right now, if you have near-term rollover, if you don't have weighted average lease term. It's, if you force buyers to make assumptions and they lack data points, they're typically going to be too harsh because they need to be conservative. And so, you're seeing slower deal flow, but the good news is, I think with the rollout of the vaccine, continued lower interest rates for longer, that and the weight of capital is going to, I think, create some velocity. But I think most of the velocity for office is going to be the second half of the year. And that's when those data points that I've been referencing kick in and capital will get more comfortable. One thing that's helping us is the debt markets. The debt markets are tremendously liquid, and we've on deals with Walt. I mean, we just did a 2% low leverage loan, on a 10-year office lease. By the way, on a 15-year Amazon deal last month, we did a 1.5% interest rate. So, low rates are going to help drive velocity, and I think once the roaring 20s, I look forward, if you look at the second quarter headline news, I mean, JP Morgan's come out and predicted GDP growth of 7.7%. Interest rates are going to be low. The vaccine's going to get rolled out. You're going to have some great headline news. Unemployment's going to go down every month as we reopen up. Disneyland's going to open up. Universal Studios is going to open up. Content creation is dying to open up. And what's going to happen once they open up, most of that's going to happen in the state where Amazon used to typically do 80% of their shoots out of state. They're going to do vice versa. And there's going to be more production in state. So that's going to help drive the recovery for office in LA. And most of that's going to occur, I think, in the second half of the year. But the second quarter is going to have a lot of great headline news in terms of, the hotels in Hawaii are sold out. The air travel's up to 150%. You're going to have those positive headline news. I think we're also going to be in for a really slow summer because everyone's been dying to go someplace, right? Everyone's been sick of pent up. And so people are going to be able to travel again. So I think the summer is going to be slow. And then after Labor Day, I think that's when you're going to see most of your deal velocity. And it's going to be with everyone back in the office. And, a lot of people, as Jaclyn said, have been kicking the can on leasing decisions. And so we see, you're going to see a pickup in leasing velocity. And again, those data points in a great debt market are going to start driving office sales. So I think it's going to be a slow start to the year, but it's going to pick up as we head on deeper into the year.
Darla, from your point of view with industrial, what is your 1 minute outlook?
I think that demand is high. The outlook of supply is slowly coming out because the demand for investors to own industrial asset class is high. And if you really look at of the 41.9 billion warehouses that changed hands in 2020, which was 25 million above, that was only down 2.5% from the year before. We think this is going to be one of the biggest years ever. We're going to see more portfolios, portfolio premiums, and on a national basis, I think we'll see additional product be brought to the market. So we'll be very robust.
I like it. The roaring 20s. I'm looking forward to it.
Yes.
Let's talk a little bit about Greater Los Angeles here. Jaclyn, I am bullish on where we are in terms of an overall market and what LA offers from a demographic perspective as well as a geographic perspective, in that we are spread out among these different submarkets across the Greater Los Angeles region. In terms of, entertainment, content creation, and shifting demographics, how do you think that will all kind of play in as we look towards the future, as it relates to LA leasing and, kind of hopefully getting into the roaring 20s here? Are we well positioned?
We are ready and raring to go. We too are bullish. So I think, it's important to look at content and entertainment consumption have been a bright spot of COVID, right? We were couch bound for many months, so no surprise there. And luckily for us, content and entertainment are still the business fabric that makes this city tick, right? One of the things we've seen, Kevin led to it a little bit, but soundstage demand has increased significantly in LA due to film onshoring. If you follow some of the most progressive developers in LA and look at their investment in owning or converting product to sound stages, it's not by coincidence. So soundstage growth is a trend we should all be looking at and watching closely. You talked about demographics, and I think as we look to the growth of content and entertainment, we should also be thinking about how do those content companies recruit and retain talent as they continue to grow. So follow the demographics. Millennials have become the largest generation in the workforce. I think that was in 2016, right? So it's now 5 years later. If you look to our geographically disparate city, right, our little fiefdoms that exist over a 40-mile radius, where do those millennials live? Where are they flocking to? Where can they afford to live, right, as they continue to age and have families of their own? The greatest concentration of millennials living in LA has shifted east. Koreatown, Hollywood, downtown, Silver Lake. So I think as we look to content, entertainment, demographic shifts, and the impact on LA leasing, I think we should expect to see continued momentum around that shift east for quality office products that can cater to those shifting demographics.
Well, I'm glad you're bullish too. I feel that, yeah, Greater LA is very well positioned to to really come out of this and start roaring. All right, Lisa, I want to bring it back over to you. So previous to our panel today, you had mentioned that Prologis had recently completed some research on the environmental benefits of e-commerce compared to the traditional brick and mortar stores. Can you give us a snapshot of what you learned, and what does that reveal about today's logistics and warehouse space?
Yeah, definitely. So MIT actually performed the independent study, and Prologis highlighted specific implications for logistics real estate and our customers specifically. So MIT's study found that e-commerce essentially on average means 36% fewer emissions per package versus traditional brick and mortar shopping. And a big factor in this efficiency is the transportation and logistics. A single delivery van can replace a minimum of 100 shopping trips that an individual or group of individuals performs. So this study also looked at urban fulfillment centers for last touch delivery, and packages originating from inside the city's borders rather than outside and traveling in reduce transportation-related emissions by up to 50% or 10% fewer emissions per package. So because of the scales of efficiency of the packages come together closer to the urban core, that really translates into the reduced carbon footprint. And if these fulfillment centers are closer to the urban core, then it means less miles traveled to the end consumer. So not only is it great for the environment, but fewer miles traveled also means less transportation costs, and powerful because transportation makes up roughly 50% of the supply chain costs. So it's a win for the environment, and it's a win for the retailers and the consumer only.
That's fantastic. And that's, I read the executive summary of that study, and it was impressive and very eye-opening. Darla, a question for you regarding cap rates. So what is driving the 4%, really sub 4% caps here in the Western region? And just for our general audience too, if you could just kind of give a layman's definition of what all that means.
Well, last year and years prior, we were hovering in the 4% cap rate, which is really reflective of what current lease rates are, and all boiled into typically 10-year cash flows. And because lease rates have been moving fast, what we have been experiencing since the beginning of the year, and actually at the end of last year, we experienced on a large sale in Whittier, California. We have now data points of multiple 3.5 caps and lower. What's astounding about the cap rates that we're experiencing today is that they're not just for a WALT of 2 years, they're 4 years, they're 5 years. And what we are in a perfect storm. The perfect storm is we have rent increase coupled with low interest rates packaged with incredible capital demand, but also layered with huge user demand and lack of supply. If you put all of that together, that's the ingredients for the low cap rates that we're experiencing, and we don't see that changing. I mean, candidly, I think we're going to see our cap rates very robust this year, and what's going to happen when office investment sales start to open up and are discounted after people understand what's happening in the office market, or not discounted. I think in 2022, we'll see some more capital move into that arena, but today, the floodgates have opened with capital moving from other asset classes into industrial, and that is one of the drivers as well. But it's clearly a perfect storm.
Indeed. I feel that there have been so many additional investors that have just been reaching out over the past really 3 to 6 months who have never really looked at industrial before and are now starting to raise new funds and are getting into it.
Yes.
So with that in mind, one last question here for the panel as we wrap this up, and Darla, we'll stay on you to kick it off. In terms of the buyer profile, in your case for industrial, contrast the buyer profile pre-pandemic and post-pandemic.
Well, what's interesting is the buyer profile, the winners of the assets that are on the market today are still a lot of our traditional capital. But we are seeing floodgates. I think it was Kevin that mentioned earlier, foreign capital come into the asset class. But a lot of that capital is coming in through operators and open-ended funds or raising of new funds. So we've seen groups now raising capital for industrial. So we have a new set of buyers. And we also have foreign buyers that are trying to figure out how to get their capital out and to buy industrial. And we have new groups that really never previously invested in industrial entering in. They're having a harder time, not because they're not smart and understand it. I think they're having to recognize the low cap rates and also what the advantage that the traditional investors have is they have assets and they see what's happening with the progressive and huge rent growth that we're having today. So I think all of those things are really kind of changing the complexion, but it's, as you just said, Jodie, it's huge demand from different groups.
Lisa, what are you and Prologis seeing in that regard? The pre-pandemic buyer to now somewhat post-pandemic.
Yeah, I mean, I'll just basically piggyback off what Darla had to say. I mean, all the focus on the post-pandemic buyer, what we've seen is, what the developers and buyers are flooding, specifically our market, because it's a strong core market. So essentially, land values are going up. So now that translates to increased replacement cost, which then gets, translated more into then higher rates and essentially then, higher prices. So we expect that prices for industrial real estate will continue to rise. I think the post-pandemic buyer is going to place a focus on key urban locations. I think there's been a lot of talk, and rightly so, about last mile, last touch supply and assets. So I think there's going to be a focus there, but I think it's an exciting place to be.
No doubt. Thank you, Lisa. Let's wrap it up with office. Kevin, what are your thoughts on the pre-pandemic buyer and post?
I can tell you this, it's gotten a lot harder in the office arena, and industrial, you're seeing the REITs like Rexford on the tear. If you look at the office REITs like Boston Properties and Kilroy, they haven't been buying much because their cost of capital isn't competitive, where the cost of capital for a Prologis or a Rexford is very competitive. So and we just priced a $300 million, roughly $300 million portfolio of industrial in Vegas, and we got 18 offers. We're focusing on 8 to 10 groups, but everybody was there. And a lot of the Odyssey core funds were bidding on that. Pre-pandemic, those same Odyssey core funds were bidding on office properties in LA. And those guys, their research is telling them they should buy life science, they should buy industrial. And so they're tepid about office right now. And so when you take a industrial deal to investment committee, it's the attitude is, why shouldn't we do this? Well, for office, it's, well, is this compelling enough, right? Completely different mindset. And so and foreign capital, by the way, is also increased their allocations for industrial. We had an Amazon Camarillo deal we closed last month, and we had 18 offers, and 8 of them were foreign buyers. Again, because of because their research tells them to buy logistics. And so on the office side, I think you can take a industrial deal, go to 10 people or 15 people and monetize it very efficiently and create a bidding war. For life science, you can go to 8 people and do the same thing and create a bidding war. For multi-tenant office, though, it's much harder. And the deals we're doing are not with people we've done business with before, to be honest with you. We just sold a DoorDash deal in Tempe for Goldman Sachs to First Cutter Bank. We're selling the PetSmart headquarters in Phoenix right now. Our buyer's a trade buyer from Portland. We're selling a big office building in Orange County. It's a family office from back east. A lot of the deals we've done are with family offices in Beverly Hills. We're doing a deal. We did a deal in Torrance with a family office from Silicon Valley. The family offices are not trying to time the market as much. And institutional capital, typically, they want to see the bottom of the market, and then they want to see the market sort of turn, and then they want to see a couple of data points. We think those data points, as I said before, are going to occur in the second half of this year, in the first half of next year. But, you know, the buyers that we're doing deals with, I mean, like we sold, 915 Wilshire to Deca, a German fund, right? We just monetized a deal in Seattle for JP Morgan. All of our bidders were foreign. And so that's, you know, foreign guys, family office, and trade buyers are really who's monetizing these multi-tenant deals, because they're not afraid to step in and do that. And they're not so focused on research. A lot of these family offices have a long hold period, and they're just, they're comfortable just buying on dips and actually enjoy the fact that they don't have to compete with institutional capital right now. The exception, for office, because we are doing a deal with Prudential and Bellevue, Goldman bought a deal in Hollywood. So if you're at one of those 50-yard line, content creation submarkets, it's still liquid, with, more typical capital. And we are seeing, by the way, we're seeing spec office development occur. I mean, Arden's on the panel later on today. He's going to build 250,000 feet of spec in Culver City. Tishman Spire is going to build spec. Boston Properties just got some land in El Segundo. We actually are having bidding wars for spec office sites in Bellevue. And so you have some smart capital that's wanting to build office, but most of the players post-pandemic are much different than the players we're selling to pre-pandemic.
Thanks, Kevin. And Jaclyn, for closing comments, I'm going to put you on the spot real quick as my bullish friend. Let's pretend that you work for a family office and you're going into investment committee to pitch why invest in an office building, multi-tenant office building in Greater Los Angeles. So give us your 1 minute investment committee pitch.
Do I have to pick a specific neighborhood, or it's free game?
No, just Greater LA, just your Greater LA and why Greater LA and investment. You're the post-pandemic buyer, potential buyer.
I'm glad I don't have to follow Kevin Shannon on investment outlook for office. I'm glad he covered that. I think if you look to the momentum behind that I spoke about with entertainment and content creation, and that is still, again, the fabric of what makes LA tick. If you look at the FANG tenants that occupy space here, HBO, Hulu, right? The real dominators of the content creation space, they continue to grow in Los Angeles. So the investment that we're looking at embodies the flight to quality that we have seen those tenants flock to, right? They are right now not looking to stack in a vertical commodity, multi-tenanted high rise in downtown LA. Someone hacks the building, they could, but the family office product that we're looking at allows us to develop high ceiling heights, great glass line scalability, and allows us to cast a very wide net for not only big game elephant hunting with a FANG tenant or a Fortune 5 company, but also potentially the ancillary entertainment and content users that are beneficiaries of all of the entertainment and content growth here in LA.
As chair of the investment committee, I would invest. Great job, Jaclyn. All right, well, thank you to our market experts that were gathered here. Great job with the LABJ getting such prominent market experts to have this discussion. And Josh, I will turn it over to you.
Well, thank you so much, Jodie. I really appreciate all of your expertise. Thank you for being a part of this panel. Thank you so much to Darla, Lisa, Kevin, and Jaclyn. What a great way to start things off as we've got our 3 panels today. We covered everything from office, industrial. We talked about sound stages. You guys touched on the impact of e-commerce that we're seeing right now and how great that's been over the last year. Jaclyn, you said something that I thought was quote-worthy, and I wrote it down. Such a simple concept. You said, follow the demographic. And I thought that was really interesting. It'll be fun to watch how those trend over the next year, 2, 3 years. We've already seen the demographic impact sectors like multifamily. That's something that we'll talk about a little bit in the second panel, but just really interesting. Thank you all so much. What a great first panel. Next up, we're going to have our second panel of the afternoon, which I have the privilege of moderating. We're going to be discussing changes that have impacted the industry. So let's get right into it. We're going to meet our panelists. First up, we've got Phil Bond, Executive Vice President, Chief Credit Officer with Farmers and Merchant Bank. Karen Hallock, Associate with DLA Piper. And we've got Frank J.H. Schulz, Managing Principal with the Klabin Company. Welcome. Thank you, the three of you, for being here. My first question is going to be more for the group, and it's a little bit more general, but I think it's interesting, and a lot of our viewers are wanting to hear these things. From your perspective, industries, how has COVID made a lasting impact? Meaning, what is something that you've adopted, either internally or with your clients, that you believe is going to have a positive, lasting impact? Karen, do you want to start off?
Hi, yes, thank you. My name is Karen, and I'm a land use and real estate attorney. So from a land use perspective, we have seen a lot of changes and a lot of different ways people are using outdoor space. Pre-COVID, I think we associate outdoor space and open space with recreational use. And now there's been a big push to use outdoor space for more commercial purposes, especially in Los Angeles, where we enjoy this great weather in the middle of February, while a lot of the other parts of the country are facing snowstorms. We really can use outdoor space more as an intensified use. And as my office is entitling projects, we are now looking at opportunities to maybe vacate streets that are underutilized or alleyways. We see a lot more variances for rooftops and using parklets. So I think that the way that we design and entitle projects now will incorporate more outdoor space post-COVID.
Yeah, thanks, Karen. That's something that we've written about quite a bit this last 6 months, just the need for the way things are designed and incorporated into planning is going to change probably moving forward. Frank, what are your thoughts on this same subject?
I think I've used an opportunity to grow my hair out. So that's definitely something that's come out of the pandemic, and that will be a lasting effect thanks to my wife. But in addition to that, I think from our industry, we've really realized that collaboration is key. I know you heard from Jaclyn and Kevin and them speak of office and coming back. And I think the one thing that we've really found value in and that we see going forward is that we're social creatures, and also there's such value in collaboration and being in the office, sharing collaborative ideas. I think that now more than ever, we found that when you didn't have it, you missed it even more.
Yeah, I think we could all absolutely relate to that. Just the idea of collaboration and how important it is to things like innovation. I think it's a little bit harder to do in the world of technology that we communicated today, but I think a lot of people are finding their ways. But I agree. I think it's important, and we'll get back to it. Phil, what are your thoughts on this? What types of things do you see that have really changed for the more positive?
Clearly, it's been a great accelerant in terms of the adoption of technology by our clients, whether that's online banking and the like. In addition to that, it's really served to reinforce the value of relationships. Banks have been hustling the concept of relationship for an extended period of time, and this has given us a great opportunity to reinforce the value of that relationship with our clients. From calls about, hey, are you guys there? Are you still lending money? What if we need a modification? We've been able to work with them on that front. And that's certainly, I think, been something that will be a great takeaway for us as well as our clients going forward.
Thanks, Phil. Karen, I want to maybe revert back to a little bit of the type of content that we talked about in the first panel. We heard them say, talk about the trends in office and industrial space. What are your thoughts on areas of growth in Los Angeles in terms of office. What are you hearing from your clients? Karen, I think you may still be on mute.
I just unmuted, thank you. Yeah, I concur with everything that was said on the previous panel, and that's exactly what I am seeing, is that a lot of the areas of growth in office is based on creative industries. I see a lot of new projects coming online and, in the entitlement phase in the Hollywood area, especially, and Culver City, but also in kind of secondary market areas in Los Angeles, like outside of downtown and El Segundo, that are driven by the entertainment industry and kind of new digital media and new forms of content creation.
Yeah, thanks. I think you're right. We're going to continue to see an impact from the digital media space, and in particular here in Southern California. Frank, okay, so this is a two-part question. First, Karen and others have identified that there are going to be opportunities. We've also heard that some investors might be reallocating away from office and retail assets and into more industrial. So the first part of the question, what effect is that going to have on the market? And then second, other than COVID, what are other factors that are driving historically low vacancies and rapid pricing increases in those areas? What are your thoughts on that?
Well, I think Darla and Kevin certainly covered the transition that the capital markets is experiencing right now away from the office and retail product types. I think one of the things, just to add to that we're seeing on the streets is, we're seeing smaller and smaller deals become institutional level as there's more and more capital chasing deals. There was mention of private investors pooling funds to start industrial funds and particularly stay below the institutional capital levels. Deals that are below $10 million, which now for industrial, could go down as small as, a 10,000, 20,000 square foot building. We're now seeing institutional capital go down and chase those deals. As it relates to kind of the overall market and some of the additional factors, I think certainly COVID spurred all of the topics that we're talking about or sped up things that were already in process. Overall, from our standpoint on the industrial front, really what we've seen is the fact that there's been just a fundamental shift in the way that companies, both retailers and manufacturing companies, are handling their inventories. I think for the last 25 plus years, it's been just in time. That's been beat into our skulls about, we don't want to carry any excess inventory. We want it to arrive exactly when we need it. And as we all saw, that didn't work out very well for retailers and manufacturers alike. I mean, just this week, I read articles about Ford and Volkswagen having to shut down production because they didn't have a chip from China. So I think that's having a huge effect, as if everything couldn't line up perfectly for industrial. With that, with COVID, with the increasing inventories, we've got 40 plus container ships that are all anchored, waiting to unload. We've got a market that's within 30 miles of the ports at virtually 100% occupancy. So this is driving pricing to really, increase 20% year over year, and probably be on pace to increase that level again this year because there is nothing available.
That's interesting. So the way inventory is handled in your mind, is that going to be a long-term change for most retailers?
I think there'll be a balance at some point, but I would, for at least the next few years until things stabilize, I think we're going to see companies hold much higher inventory stateside because they don't want to be caught without having something available within 2-day shipping window.
Yeah, that makes sense. And sort of sticking with the retail topic, we've seen some new trends, and that's one of them from an internal standpoint. There's also other trends that impact the customers. So trends in retail and with shopping centers. Karen, tell us a little bit about what some of the trends you're seeing are, and then also how are you advising your clients, whether it's from a customer standpoint, the way they deal with their customers, or from just a business standpoint as an advisor. What are your thoughts?
Yes, so I'm seeing a couple of trends in large shopping centers and maybe underutilized malls. And there's a couple of uses. Well, pre-COVID, we saw a push for those types of shopping centers to be entitled for mixed-use residential buildings. And now, most recently, we're seeing kind of a shift to repurpose those buildings, and kind of piggybacking on what Frank said. And what the previous panelists mentioned is that a lot of companies, or there's a need for these last mile distribution centers in urban centers. So these shopping centers and retail centers are kind of ideal for that type of use. But that can be tricky because in urban centers, the zones might not allow for that type of use, or might not expressly call out that that is allowable. And what you'll find is that a lot of neighbors and neighborhoods oppose that use. They don't want large trucks in their neighborhood coming in and out. And that has to be met against the needs for these companies to meet those demands of faster delivery times. So it can be tricky to navigate, and you really have to do work and do outreach with the neighborhood and with the city to convert retail into those types of uses.
So Karen, so from a logistics standpoint, just coming off of your comment there, last mile distribution centers are extremely important. Are you saying that there's a greater need and there are more challenges in getting those established? Has the demand outweighed the supply at this point?
Yes, I think there's a greater need for them in Los Angeles and in urban centers, but they can be tricky and difficult to get approvals for. But certainly we've seen a bigger push for them.
Okay, thank you. Thanks for the clarification. Phil, I want to talk to you from a banking and from a more of a lending perspective. You and I, prior to this call, we've had conversations, and you mentioned that farmers and merchants, first and foremost, are real estate lenders. Karen and Frank have sort of provided some insight into the market. I'd love to get your input more from a lending perspective. How do you see the LA commercial real estate market being impacted this next year? What are you seeing from your clients, and how are you helping them?
This year, and I think at least for the next couple of years, it will be a very good time to be a borrower. As we heard in the previous panel, the liquidity of the lending market today is very high. Life companies, banks, credit unions, loan funds are all looking to put money to work today, which is a very good thing if you are out there as a borrower. It's going to require banks to be creative. I think we need to be anticipating the needs of our clients. We've got to be creative with regards to the terms and conditions. We're seeing clients today who are getting offers they never expected in terms of price, which is causing them to rethink, geez, this has always been a long-term hold. Now I'd like to get out, but I was in a credit facility over here that had a defeasance or swaps or other entanglements that put a little friction in the way. So as lenders, we need to be prepared to work with our clients to help them respond to a very demanding market out there, both in terms of the purchase side and the sales side of these transactions.
So, and I know this is probably a much more complicated question, but in the simplest form, do you believe that there is enough access to capital for your typical business owner who's out there looking for it today?
Well, I think so. I do. There's a lot of opportunities out there. The SBA market is a very viable market, both the 7A and the 504 loan programs. Those are alive and well. So yes, I do think on really every point of the spectrum out there, from the very sophisticated to the family offices, which are really emerging as a force on the real estate front, which was mentioned earlier, all the way down to kind of the, they own one building type of investor. There's ample opportunities for them to tap into a whole range of funding.
That's good to hear. Obviously, it's so important. We've heard about trends. We've in a couple of different areas now. At the end of the day, though, whether it's funds, whether there's legal issues, whether or not there are tax implications, nothing happens unless a deal gets done. So my next question, I'm going to ask Frank, what challenges are you anticipating happening in order for transactions to get completed in 2021? And do you see any economic challenges that may be similar or different that could get in the way?
Well, as a broker, we subscribe to the philosophy that time kills all deals. And I think that's now more evident than it ever has been before. And sadly, it's really clients who are up to speed on market pricing and ready to move quickly who are getting the deals done. If that is not the case, they have lost out and will lose out on future deals. So, that's something that we're trying to do a better job of educating our clients and helping them get out in front of things, knowing there's going to be longer lead times and being prepared on what market conditions are. I think from a transactional standpoint, it's becoming more and more difficult, and I'll, piggyback on some of the stuff that Karen said regarding, regulatory and environmental issues. But, right now, for every one lease that we're signing, there's 3 subsequent leases that need to be completed in order for that one to, that tenant to be able to actually occupy that space. I kind of call it vacancy musical chairs right now. And so, that's creating all kinds of legal challenges as far as holdover and undeliverability of space just due to the lack of vacancy. I really don't think that's going to improve anytime soon with the backup that we're seeing at the ports and just really the increase in import volume. So I think that's really ultimately going to come down to us just working with clients and setting expectations that just because you sign a lease and your lease starts March 1st, you may not be able to move in March 1st. On the economic side, well, before I get to the economic side, I will touch on the regulatory aspects. I mean, we're seeing whether it's development or it's just putting a tenant into a building and getting a certificate of occupancy. Karen used a word we like, or made me think of, we call it NIMBY, which is not in my backyard. And, we're seeing that on all levels as you see increased truck traffic and, vans and, people running around in these neighborhoods. There's certainly, we're all relying on e-commerce and we all love this, but I certainly don't want a Amazon distribution center down the street from my kid's school. So that's certainly something we're all dealing with and having to be sensitive about. We've also seen environmental standards, as I'm sure Phil will speak about. Environmental standards have changed and has complicated sales transactions tremendously from a lending standpoint. So, those are some of the challenges there. Economically, I think we've heard the roaring 20s. I've heard post-World War II boom. I'm a very optimistic person. So I do believe, even as Jaclyn had said on the previous panel about, the fact that people are going to go back to the office. And certainly we've given rainbows and unicorns to industrial here, but I do feel positive about the other asset classes as well in the long term.
Thanks, Frank. I appreciate those very different and interesting perspectives. You talk about vacancy musical chairs. That's probably something that, we as a publication and understanding some of the deals that maybe don't get done. Why do those things not get done? What are the contributing factors? That'd be an interesting take for our reporters to look into and to talk about. And I love your comment about time kills deals. I think that is probably something that can be said throughout most industries. And when things stop and conversations stop, deals usually stop. So I think those are all great points. Phil, I want to hop over to you and just, when it comes to getting deals done and challenges that might arise, what are some of the latest in real estate developments from your perspective?
Yeah, not to dampen anybody's enthusiasm or to take the shine off the roaring description here of what markets lie ahead for us, but there are a number of challenges associated with what we're seeing out there today. Frank just touched on it. Environmental standards certainly are an issue. You're seeing properties that haven't changed hands in a number of years, that have not been subject to the due diligence for vapors and the like. So you're seeing issues like that that are slowing deals down. Please bear in mind the appraisal process is being extended out. There's a limited number of appraisers out there. The information they're receiving is tough for them to sort through. With the acceleration we've heard about in terms of rental rates, they're used to looking in a rear view mirror, and borrower buyer expectations are very forward looking today to satisfy their yield requirements. So you might see a little mismatch there in terms of expectations through the appraisal process. Title is also experiencing some delays these days, and they have heightened sensitivity to certain types of transactions for private party notes and the like. So I think you need to pack that into your expectations for source of challenges. Labor and material costs, there's certainly some unknowns around where that will shake out in the next 6 to 12 months. And then Karen and Frank have both touched on city approvals, timelines for redevelopment, land use going forward. Yesterday, I was down at what will soon be the new Amazon distribution center in Santa Ana, the old Orange County Register printing facility. Now that's an existing site that used to have a lot of truck traffic and the like. So maybe those types of facilities will be what we see swapping in and out of the vacancy shift there as location priorities shift. So I think hopefully that provides a little assessment in terms of what challenges may lie ahead for deals in the future.
Yeah, Phil, thanks. That makes a lot of sense. It sounds like what I'm hearing from, I guess, the panel as a whole is there is access to capital. There are opportunities, but there are also things like, that delays and timing and issues that are impacting deals actually getting done today. And they need to be taken into consideration when looking at timing. Things seem to be moving, but they're moving slower. Okay, we've got time for 2 last questions on this panel. I mentioned residential earlier. So we are seeing changes in residential development. A few weeks ago, the LA Business Journal hosted a panel that specifically talked about adaptation in multifamily development, the type that's come specifically from COVID, and we're starting to see it in other areas like outdoor space, as was mentioned earlier. Karen, what are some of the changes that you're seeing in residential development as people are seeking to move out of dense areas?
What I'm seeing is a lot of small lot development. A couple of years ago, the city made it a little bit easier to obtain approvals for small lot development, including, relaxed standards for minimum setbacks and minimum lot size areas. So we're seeing a lot of small lot developments and those types of subdivisions coming online. As people are moving out of dense areas, small lot homes are more affordable and more accessible to people and provide a little bit more space than in dense neighborhoods. So on the one hand, we have people moving out of dense areas. And then right now, of course, we also have people who are staying in dense areas because they have to. And, fortunately, as the number of COVID cases decrease, what will happen is that the eviction moratorium in Los Angeles that is currently in place will be lifted. And these, as you had mentioned earlier, these are kind of unprecedented times. So what, we hope to see is that there won't be a huge movement or shift of people because of that moratorium. And the state has implemented certain measures to provide subsidies to both tenants and landlords to repay past due rent. And we certainly hope that those programs and measures are successful.
Yeah, Karen, I'm glad you mentioned that. That's something that, we write about often and we all follow almost on a month-to-month basis. What's going to happen with these moratoriums? How long are they going to last? What type of protection is going to continue to exist? Who's being protected for how long and what the long-term implications are? So we'll certainly keep an eye on that as the things change with COVID. All right, we're down to our last question. I'm going to address it to each of you, sort of in a quick response. So what I'm looking for on a scale of 1 to 10, 1 being not very optimistic at all, and 10 being overwhelmingly optimistic, how would you rate your overall optimism about the strength of the commercial real estate industry as a whole? And let's be specific to Southern California, the LA region in 2021. Phil, let's start with you.
I'm a solid 8 on this one. I think retail will continue to be a bit of a drag as it finds its way going forward. And I think office will be a question mark, and that's going to take years to play out.
Thank you, Phil. Frank, where are you at?
I'm at 12, Josh. My reasoning for that is in Southern California, we have a housing shortage. Commercial land is being gobbled up daily for additional housing. And as far as I can see, there's no land left in Southern California. So in a land constrained market, I'm going 12 long term.
We got an 8, we got a 12, that's an average of 10. All right, Karen, where are things going to end up?
Well, I'm also very optimistic, and I would say I'm at an 8 also. And in my practice, I look kind of years ahead because it does take a couple of years to entitle projects. So I'm seeing big investments now that will come online after 2021. So I think that my 8 will increase as the years go on.
Well, there you have it. I think there's a lot of optimism is the general message that I'm hearing. I want to thank Phil, Karen, and Frank for your participation, for all of your time, your energy that you put into this. That concludes our second panel, and now we're going to move really fast right into our third and final panel. I think this one's going to be really interesting as well. It's called LA Rising, a development update. So without any delay, please welcome John Blanchard, founder and CEO, Boulevard Hospitality, Arden Hearing, Executive General Manager, Lendlease, Eric Schreiner, Executive Vice President, Southern California Operations Manager, AECOM, AECOM Tishman, and lastly, our moderator, Larry Bond, Chairman of Bond Companies. Larry, thank you so much for being here and welcome.
Thank you, Josh, and thank you, Los Angeles Business Journal, for providing the opportunity today for us to share our thoughts on real estate development. It's clearly been the craziest year since I co-founded my company back in 1987. Some quick observations to share and things to think about as we view development for 2021 and beyond. Because of the pandemic, we've all seen real estate adopt the use of technology at a pace that was never seen before and is literally changing every part of the real estate process. Almost all of the economists from UCLA, USC, as well as bank economists have stated that the economy is about to take off starting in the second quarter with a 6% to 7% GDP rate and leveling out at 2 to 3% starting in 2022 and beyond. Is COVID-19 an event or a permanent condition? Perhaps we look back to history 100 years ago when in 1918, the Spanish flu was as devastating as COVID-19. Yet, a year later, people were socializing with no restrictions. What impact does the proposed $1.9 trillion stimulus have on real estate development? Is inflation on the horizon? How are my fellow panelists thinking about these issues and opportunities that lie ahead and reacting to these global issues that have clearly impacted us? We're going to cover a lot of information today, so we're going to keep our answers short, so let's jump right in. The first question's for the entire panel. What are some of the things that you've learned internally as an organization from the pandemic that will carry beyond? Eric, please kick it off.
Eric, I think you need to take your mute off.
There we go. How's that?
Perfect.
I appreciate the opportunity to be on this panel. Thank you, Larry, and appreciate it's a pleasure to join John and Arden to talk about development here in LA. It's an exciting time. It's going to continue to be that. And clearly this last year has been unexpected and unprecedented for all of us. I think some of the takeaways from us has been, you know, if we start at our job site level, the way that we manage our job site operations, everything from, you know, the single point of entry and the crew sequencing, the manpower strategies that we have about their social distancing has created a lot of things that we're going to carry forward as we move on from this point forward. I think also there's a few other important things. One is, you know, the confidence that we've developed in teamwork. In these unprecedented times, we've been challenged with things we never knew about or expected. We've been an essential business, so we've been working full time the whole time. And we've been, you know, we've had a lot of things thrown at us, and it has taken us all working together to overcome them, to be successful in continuing in our industry. And I think that's really created a lot of strength and commitment on the teamwork side. I think the other thing that we've taken away is that there really are some things that can be done in our business remotely. While there are still a lot of things that need to be done face to face, like interviews and negotiations and things like that, there are some things that, you know, especially in our pre-construction service side of the world, that can successfully and efficiently be done remotely and provide some flexibility for some of our team members. I think another piece is, you know, always from a business strategy standpoint, always preparing for change. Whether you've got a business plan, you've got a budget, you never know what's going to be thrown at you. So you can't just get locked in that once it's in place, that's all there is to it. It's staying on top of things on a daily basis and making sure that you are flexible to change as you need to. And I think the last one just for me is, you know, personal space has kind of been nice. And I think as we move forward out of this, that's gonna have a big influence on how we operate, not only in the construction world, but also in our office operations.
Thanks, Eric. Arden, what thoughts do you have to share?
Going off mute here. Hope you can hear me. Let me know if not.
Perfect.
Yeah, so this isn't really about real estate. What came to mind was something about kind of leadership and management, which I think this has been the most challenging year in my career from a leadership perspective. And it's that being virtual sort of reminds us that it takes a very deliberate, conscious effort to maintain and set the culture of our organizations and also what the well-being of each individual on our team, that it takes one-to-one, top-down, hand-to-hand style of engagement. So I'm a much better leader because of this particular year. Thank you.
John, your turn. What would you like to add?
Yeah, I would say, you know, we quickly, we had about a half a dozen projects in construction or going into construction during the March lockdown. And we quickly adapted and made sure our team was safe when we were visiting sites. You know, we quickly adapted to hosting all of our project meetings and investor meetings on Zoom. And I was very impressed with how everyone, not just in our office, but others, got together and were able to, you know, work together digitally. I will say, having lived with this now for, what have we been in this, 12 months now, it does have its challenges. And I would say that not only myself, but my office is looking forward to getting back into conference rooms and having face-to-faces with our architects and our contractors. And I do think there is a gap that is missed doing everything digitally. So I think we're looking forward to that and getting back. And obviously a safe way until we can be mask-free again.
John, thank you for your thoughts. So Eric, including that little project called SoFi Stadium, that is just one of the most amazing looking projects that I've ever seen, at least externally. What projects does AECOM Hunt and AECOM Tishman recently completed, and what's next?
So you had commented about the economy taking off. It's been an incredible wave that we've been riding over the last few years. We've been fortunate to have been involved in a lot of things recently that have taken place and have helped shape, the LA Rising. And so in addition to SoFi Stadium, if I go back a couple of years, the Metropolis was a mega mixed use project that was both residential and hospitality. Avon is a tower downtown, residential tower. Circa, a couple of towers downtown that are residential. Ren's another residential project downtown. We did the LAFC Performance Center out at Cal State LA for LAFC soccer team. And then we completed a smaller job, a trellis addition at the Waldorf Astoria in Beverly Hills. Most recently, in addition to SoFi, that little job you mentioned, and I can't wait till people have the opportunity to enjoy the facility. At the Coliseum at USC, we recently completed the renovation, the premium seating upgrades, the new seats that were installed there. In West Hollywood, we have a mixed-use residential hospitality project called Pindry that's just opening. That's a beautiful luxury project. We also have a small project even down in La Jolla for Novartis, a new chiller plant that we've installed for them. So it's really been a strong mix of different market sectors, mostly here in LA and the surrounding areas. And it has touched on a lot of, different market sectors from residential, hospitality, sports, and even some industrial. So it's been quite a ride actually over the recent past.
Thank you. So John, let's turn back to you and talk about what you're developing now and what changes have you made to your new projects that will be breaking ground this year?
Changes based on, going forward with COVID and changes.
Exactly. We're all having to adapt to what the pandemic and other things that are going on.
Yeah.
I'd like to get your insight.
I'd say one project in particular that we're going to be renovating very shortly. We recently acquired the Georgian Hotel in Santa Monica during the pandemic. And, we were debating what changes are going to occur from a guest experience. And what I'd say is, having been out to some restaurants during this, and I'd say there was a brief moment of time where we allowed in dining, if you guys remember. And I just watched how quickly people were just back to their, normal ways of living kind of pre-pandemic. So, we're not looking at drastic changes right now. I would say that we want to give our guests the flexibility of having their rooms cleaned or not being cleaned or multiple times a day. Also having stations throughout the public space to sanitize. But one of the areas that we looked at was the conference rooms or the meeting rooms in hotels, and how can we better utilize those spaces in the evenings for folks that want to dine out and perhaps not want to be around groups of people that maybe they don't know. So as an example, somebody wants to have a dinner party or birthday party. So what we're doing with some of our conference rooms are making them nicer private dining rooms that will act as a flex space and, a work function space during the day, and then an evening nice enough to rent it out for a party of 10 or 12. And again, to kind of just be with the people that they know, that they kind of trust. So I would say that, but nothing really drastic. We believe that when people are allowed to dine in again and kind of live mask free in a way, that things will quickly get back to the way that we've been for a while.
Thanks, John. So Arden, many developers and investors this last year have hit pause as a result of COVID, but Lendlease appears to be not only investing, but rapidly growing. Can you talk a little bit about your growth strategy and what you are doing up here on the West Coast?
Yeah, sure. Thank you. A lot of people in Los Angeles know Lendlease as a general contractor, and it's true that is part of what we do. But globally, we're listed on the Sydney Stock Exchange. We have a nearly $100 billion investment and development pipeline. So I came on board 2 years ago to build our West Coast investment platform and development platform. We have a large building in San Francisco, and now with Kevin Shannon's help, we closed before the end of last year on a large site for about 500,000 square feet in the West Adams area of Los Angeles on the border of Culver City. And I think that's the type of investment that we will continue to make. We think now is the exact right time to be aggressive in the cycle. We know it felt really good 2 years ago to trend rents forever and use really high record-breaking rents. We know that was wrong, and that was really uncomfortable. Right now, it's a little bit less comfortable. It's harder to get data points, but we're very optimistic on the midterm. We think this is going to be a major year of transition, and we'll be making more similar investments in Los Angeles.
Great, thank you. So John, again, along the same lines, talk to us about acquisitions in the hospitality and hotel space last year and what's going on for 2021.
Yeah, that's a good question. We've been paying very close attention to the trends, both from tourism and business travel and so on and so forth. And one of the areas that we see as being problematic, at least for the short term, are places like downtown LA, which we are big believers in. We developed a number of assets down in downtown. But with the convention center and the arena and office, it's really struggled. And some of the areas that we've witnessed over the last 12 months that have performed actually quite well based on our current circumstances have been coastal areas, also desert areas. Your Palm Springs, your Santa Monica, your coastal areas. And so, that's definitely a focus for us right now is what are the areas that actually performed quite well during, this past summer and going forward. And so that's a focus. And I think, it doesn't mean that you're not going to be able to get your hands on some great opportunities in areas that have struggled maybe harder than, our beach cities, because there are. But I think for us, just limiting our risk a little bit, we're going to be looking more in areas that performed well.
Thanks, John. So Arden, I want to come back to, the 3401 South La Cienega specifically that you mentioned earlier. Why did you select that location to form, your flagship property that I read about was going to cost about $600 million? What do you like about it?
Arden, I think you're still on mute. If you could just grab the button.
Oh man, I said something really insightful too, and you all missed it. So Los Angeles is an amazing city, as we all know, but we think that the trend towards, and this is COVID or not with COVID, it doesn't really matter, towards a 15-minute city where people can bike and walk and drive if they want to and live a great, kind of call it semi-urban life. We think that Los Angeles is absolutely going in the right direction there. And we see this neighborhood on the edge of Culver City being exactly that, where I've ridden my bike from the beach to the site, and it's fantastic. You can walk to Apple and Amazon and HBO, lots of jobs. So it's a bit of a perfect storm on that particular micro submarket. But we see many other micro markets around Los Angeles where we have these semi-urban nodes. We don't think density is dead in any way, shape, or form. We think density is changing. We think transit is still the future, and very excited about how that happens in Los Angeles.
Thanks, Arden. So Eric, you have obviously, AECOM is a massive company, billions and billions of dollars a year in construction development projects all over the place. And as you think about, and you shared some of your pipeline earlier, but as you think about your pipeline and how the pandemic has impacted changes, construction, development, and so on, what have you noticed as to how that's impacting what gets built? And how are you at AECOM reacting to that?
Well, it's really interesting. The projects that we have under construction right now are kind of a mixed bag. The Grand is a mixed use residential hospitality. We have a hangar out at LAX for United Airlines, so an aviation project. Curb on Wilshire is another Koreatown residential project. And then we're also finishing the performance venue out at SoFi. So you've got a really good mix of market sectors in that group. What we're seeing with our clients, our development clients moving forward, we have a ton of projects in pre-construction right now, but hospitality, and John can weigh in on this even further, but what we're seeing is that's a really hard development to get underway at this point. Residential seems to remain really strong, and we have a lot of strong appetite from our development partners in that. Some of the other panelists have talked about office. There's, depending on the kind of office, I think there's some good movement there, but what's really exploded, and it's already been said in the other panels, is the studio and creative office work. And so the content and entertainment industry is driving all of that, and we're seeing a huge explosion in the development of those things. Retail, is sluggish right now. Sports continues to remain very strong. So it's what we're doing is, we're following the data, we're following the clients, and we're just trying to make sure that we're able to provide for our clients what's needed for what they want to establish. But that's kind of what we're seeing.
Thanks, Eric. So John, what are your thoughts? Obviously, you're coming from the hospitality-focused business. So what are your thoughts on the same question? And how the pandemic?
Yeah, I would say it's really going to depend on, just focusing solely on Southern California. I think it's going to depend on where you're going to build. Are you going to build into a market that's heavy demanded by convention business or office business, or is it more travel and leisure? So we take that in mind. But I would also say it's if you're doing something ground up right now, you're going to have your challenges. Lenders don't really have an appetite right now unless you want to go full recourse, and even those are kind of few and far between. So I think there is capital out there right now for repositioning, buying existing hotels, and there is capital out there, and I think that there will continue to be. But again, we're just cautious on where we are doing things, and again, I think that we feel safer doing them in markets that have performed well during the last 12 months.
Great, thank you. So Arden, back to you. What's, besides obviously 3401, what's next for Lendlease, in LA? And, how are you looking at opportunities right now in Los Angeles? Is it, the big mega projects? Are they mixed use? Are they multifamily, the office? What's kind of the vision and the game plan? You may be on mute again.
Sorry about that. We like scale all the way up to our $15 billion joint venture with Google in Silicon Valley. We would stay around that size of La Cienega, maybe down to 250,000 square feet. First and foremost, we're trying to build the team. It's still a very, very tight market. So working to build that bench of talent in Los Angeles, and then looking at those A+ opportunities in those 15-minute city type of semi-urban nodes, and absolutely grow the platform.
Great. So, John, I know you talked for a moment about Southern California a little bit, but maybe you can share more of a perspective also about the future of hospitality and what regional trends that you're seeing in hotels from other parts, perhaps the United States, even internationally, that you think they're going to impact guest viewpoint and standpoint and operational issues or opportunities for that matter.
Yeah. So, during the last downturn that we had in, 07, 08, 09, what we saw come back, well, it actually did perform well during that time. And it's kind of the first to come out very, very strong was the, more of the select service, limited service hotel sector. So, folks that don't want to spend a lot of money on a nicer room, but a decent enough room. One of the things that we noticed are people are rediscovering California again, which is great because obviously folks couldn't get on airplanes. And so we saw massive trends, again, through deserts and beaches, Montana, Jackson Hole, Utah. And so we're seeing folks look at those markets quite serious. A lot of folks are looking at Salt Lake right now quite seriously, and other markets like that have kind of been overlooked over the years as folks have been more paying attention to downtown and West Hollywood and areas that have been booming for quite a while. So we're actually also going to be moving a little bit into residential. For the last 10 years, we've been 100% focused on hospitality. And I think, we all got woken up with what happened to our industry. And even though we're big believers and we're betting big and we've bought a few projects during the pandemic, we're looking at more and we're going to continue to bet big. But we're going to move into that a little bit as well, something we're excited about, and some things we'll be announcing soon on that. As far as operationally, it's hard to say. I don't know what people are going to do just yet. I will say that prior to the pandemic, we started to see hotels that were having kind of touchless entry points to the room. So by the time you get out of either your Uber or your car, you can go right to your room without having any interaction with anybody. And that's been kind of growing slowly pre-pandemic. I think we're going to see more of that in kind of that select service world. And I think that in the full service world, you might start to see, like when you go to the airport and check in and get your ticket at the kiosk there, I think you might start seeing kiosks pop up here and there, so you don't necessarily have to interact. But again, I think, I'm hopeful and optimistic that coming out of this, people's trends and behaviors are not going to 100% change. I think you will have a certain group of people that this will last a lot longer for, and I think you have to plan for that. But I'm betting on a larger portion of the population is going to get kind of back to previous trends of your kind of 2019 and prior. But again, kind of planning for folks that want more of a touchless experience. Did I answer? I think you asked me 3 or 4 things there. Did I answer most of them, all of them?
You did great. Thank you. Really appreciate that.
Okay.
So we're nearing the end of our time together. So I have a final question that I'd like everybody to weigh in on. What does the future pipeline really look like for Los Angeles? I know that you've all kind of shared your thoughts already on what your companies are doing, but is the outlook rosy? Is the outlook mixed? Is the outlook still pessimistic, or is pessimistic from last year? Because I'm hearing a really good optimism, but I'd love to get everyone's individual thoughts to share for the audience one last time here. Arden, why don't you kick it off?
So I feel optimistic, but part of that is because the pipeline is dwindling. Construction starts have fallen off a cliff. Just drive around downtown and do a crane count versus 36 months ago. It's staggering. We should see that filter through to construction costs very shortly. I debate that with my brethren on the GC side. We think subcontractor margins will snap back very quickly, and if not, the subs will just won't have work, and then they'll snap back. So that's coming. So short-term pipeline is dramatically less than it has been, and that's a very good thing. Larry, you're on mute now.
Is it?
John, why don't you go
Larry?
next, and then we'll have Eric wrap.
Okay. Yeah, so I would say we are extremely optimistic, but it really is based on the conditions that our local governments are putting on us. As I had mentioned earlier, when we had that brief moment in Los Angeles where we could have indoor dining, it was booming. We have outside dining right now. It's doing very well. You know, we study other states that have pretty much been wide open for the last 6, 7, 8 months. You take your Florida, your Miami, Dallas, Aspen, a number of other areas that are, it's almost like it doesn't exist. And that's, you know, for local travelers. You're not seeing a tremendous amount of, you know, airplane traffic coming in, but, you know, that's going to take a moment to come back. But I think as soon as these restrictions are lifted specifically around Southern California, people are going to be out and about. People are going to be booking. You know, in our hotel that we have in Santa Monica, this past July and August, we were running 90% on the weekends. Now, granted, our ADRs were not where we would like them to be, but this is all people pouring in from Nevada, Arizona, and California. And I think that we're so fortunate to have the weather that we have, the population, the surrounding states. So I think if you're in hospitality, hotel, restaurant, especially if you're in, you know, areas that are more kind of destination driven, you're going to do well. And I think we're going to snap back very quickly. I think where we're going to see some challenges is going to be in the business travel, the group travel, and the East Coast and European travel. And I'm thinking that's more next summer. But I think this year, again, if we can get these restrictions lifted, it's going to be a pretty good year for us out here in LA.
Thank you, John. Eric?
Yeah, I would tell you that our pipeline outlook is very optimistic with some caution. And I say that our pre-construction load right now is higher than it's ever been. We have a lot of developer clients really interested in doing a lot of things. There's a lot of residential. There's some hospitality, some visions of hospitality. There's sports, creative office, and studio space. As I said, that has exploded, and we've got several really large jobs related to that. The cautious part is, as Arden mentioned, you know, construction starts have really declined. And so the developer's ability to get the funding and actually get projects started is what we all have our fingers crossed for. We see that as something that's going to take care of itself over the near future. And with the pipeline of work that we already have in the shop with the pursuits, we've got an incredible pursuit load that we're in the mix on, and it's just astounding that given you know what we've been going through, that all of this is still in place. So very positive, but cautious, and fingers crossed that financing can come through. This is, you know, in my opinion, this is one of the best times for a developer to break ground. We do see prices coming down. Contractors and subcontractors need backlog, and they're willing to give some pretty aggressive pricing right now to make that happen. So
Thank you, Eric.
We're very positive about the future.
Thank you. I really appreciate that. So, you know, I was to say, which for my own company, we do a lot of multifamily development here in Los Angeles and across the U.S., but primarily in, you know, major cities. And, you know, we are under construction with one project right now. In Hollywood, we finished one, and we have 2 new projects that we're going to be launching sometime this summer. And we're finding a lot of the same things that Arden and Eric just mentioned. The pricing is becoming very competitive, which we haven't seen in a long time for contractors. And there's a little bit of a perfect storm, although the economy overall we took a hit with COVID last year. There's a little bit of a perfect storm because interest rates are low. And so from a developer perspective, if you have the ability to get the construction loan and get your equity situated, the returns are better than they've been in a while, even with the softness in the marketplace due to COVID. And the last point I'd make on that is, as we look to what's going on with potentially immigration reform and other things, there may be another 250,000 to a couple million people coming back into the US based on immigration reform, and that leads to housing. And there's also about 52% of all millennials that are still living at home. So as those millennials start to get out of the home and get to their own apartments, that too should really benefit large cities like Los Angeles with a very diversified economy. Anyway, so I'd like to thank my fellow panelists for sharing insightful and really compelling information today. And I hope everybody tuning in found some really great ideas, inspiration, and motivation to keep our industry and Los Angeles moving forward. And last but not least, really, I think we all want to thank the Los Angeles Business Journal for allowing us to share our thoughts today. And I'll now turn it back to Josh.
Well,
Thank you, everyone.
Thank you so much, Larry. I think there's some really interesting notes that I took from this last panel discussion. John, you talk about how the industry, the hospitality sector, has really been negatively impacted over the last year. At the same time, how many opportunities are coming and how many different ways for the industry to rebound. And you talk about interesting things like select service. I'll be curious to see where that goes in the next year or two and how many changes are made in sort of the planning for those types of things. And I think I'll leave it on Eric's quote of, where do we look? What's our vision moving forward? And Eric said, optimism with caution. So I think that's a good ending note for us. Optimism with caution. Thank you to our last panel, Larry, John, Arden, and Eric. You guys were all fantastic. I want to give a virtual big round of applause and thank you to all of our panelists from all three panels today. Thank you to our sponsors for supporting today's forum. I want to remind you all that next week we'll be hosting part 2, which is our awards. And that's where we're going to be honoring the very best brokers. And we're going to name the most impressive projects of the year across about 10 different sectors, which I think is going to be outstanding. Such an exciting year to celebrate. So many great projects come to completion over the last 12 months, despite such challenges. So if you haven't registered for that yet, please make sure that you go online and do that. You're not going to want to miss it. Thank you all for being a part of today's discussions. We look forward to seeing you next week. Have a great day. And until we see you next time, please stay safe.